Okay, dear students, the objective of today's class is to motivate you guys, and as you guys have potential and these are the last days, I hope you are working hard. So to give you confidence, and there is one sensitive area of your course which is MTQs, section B, OT cases. Okay, and I'm sure you guys know about this, that in the section B there are 3 questions and each question contains 5 MCQs type questions. And in these 5 MCQ, if you do in one MCQ, if you do one thing wrong, like true, false, you have 4 options in one MCQ: true, false, true, false, true, false, true, false. And if you do one wrong, so you will get complete 0 in that MCQ out of 2 marks, right? So MTQ is comparatively dangerous than the other sections because a slight mistake can cost you you will lose all marks. You like complete 2 marks, not 10 marks, right? So each and every question you need to check thoroughly. Now, I'm sure you guys working hard in these days, especially you guys are doing mock exam. You guys are revising your summaries. You are doing practice on your practice platform, ACCA practice platform. I'm sure you are doing practice platform, and you are staying away from negative people. I always say to stay away from negative people, because just think, you have taken all the classes which previous students also took, and you know the results. So you have followed everything, like you have done all, you have taken the classes, you have attended the revision days, you have sent your scripts for marking of ratio analysis, you are doing mock exam, you are doing revision, you are doing full-time studies. What else is left? So now it's very easy to clear the paper. Just send this message to your mind. Don't think negative. I sometimes say this thing, whenever a student, I've seen many doctors like that. Those doctors who do first they do MBBS. Now, what parents do, like if you are in the 2nd year of MBBS, parents start calling their son or daughter as doctor dash, doctor this, doctor this. Why they do this? They do this to transfer the confidence in the kid that yes, you will be a doctor. So now I would advise all of you, please close the camera. I told you many times, I would advise all of you to write your name as F7 cleared. Keep your name, put this on your home screen that you have cleared F7, your name F7 cleared, and give this message to your, see, one student is commenting, my father now calls me ACCA Sahab. Yes, so just give this message to your mind. Or one more thing I would say, treat yourself as a winner. Okay, because you have done everything. And this is the age of technology. You know, you have all the materials, everything is available even on YouTube. You have seen many lectures, you have all the exam techniques, everything. So now don't worry about it. Don't think negative, especially on this last week. Treat yourself as a winner. This is the best message. This is the main message which I can convey you, right? Treat yourself as a winner. So now we are doing some new questions. Obviously these questions are not in your Kaplan exam kit, some new questions, so that's why you will have some different taste. So our first question is, dear students, our first question is, Jeffers Company prepares financial statement for the year ended 31st December X8. Wait. The financial statement are expected to be authorized for issue on 15th March X9. So this question, as you can see, this word authorized for issue or approved, you can see it's connected to IAS 10, little bit connected to IAS 10, events after the reporting period, okay? And you know, in IAS 10 we have 2 types of events, adjusting events and non-adjusting events, adjusting and non-adjusting, okay? Adjusting events are those events which gives us evidence that that the chances of that event was available at the reporting date, right? Okay. And non-adjusting event, there is no further evidence. So for adjusting events, we need to adjust the last year financial statement. And for non-adjusting event, we just need to make a disclosure in the last year financial statement. Just need to make a disclosure in the last year financial statement. Okay. Now let's start. And when I teach IS 10, even my IS 10 is available on YouTube as well. When I teach IS 10, I say there are, for in your F7 or F3 level, normally examiner tests famous examples. Examiner test famous example, and same they have done in this question. See, health and safety fine. It's connected to IS 37 as well. Fines and penalties. A health and safety investigation of an accident which occurred, see this. That means accident happened in X8. Accident happened in 2000 X8. Accident happened in 2000 X8 last year. Was concluded in January 2009, resulting in 1.5 million for Jeffers company. A provision of 1 million had been recognized in Jeffers company's financial statement for the year ended 31st December X8. Now, I would say this is adjusting event. This is adjusting event. Why? Because what was the reason of this fine? The reason of this fine was accident, and this accident happened last year. So the reason already existed. The reason of this outflow existed at last year. That means at the reporting date, we have the evidence that we have to pay. So yes, you will record complete 1.5 million provision last year. You will record complete 1.5 million provision last year, and this is adjusting event. Even we discuss this thing in our normal class as well. This example we discuss in our normal class as well, that we supplied some faulty goods. We supplied some faulty goods to customer last year, and because of eating those faulty defected goods, customer got sick and hospitalized, and then customer filed case on us. So yes, this is also adjusting event because we sold the bad goods last year, right? So yes, this first one is adjusting event. The second one, customer ceased trading. So it's about bad debts. The most famous example of adjusting event. Let me tell you one very special thing. The day we do credit sale, we get debtor in our books. The day we do credit sales, we get a debtor in our books. And the moment debtor is created in our books, at the same second we have a credit risk. The moment you see debtor in your book, you record debtor in your book, the next moment you are aware of the credit risk. That means there is a chance. of bad debt. That means there is a chance of bad debt. Right? So yes, if there is a debtor at the year end, if there is an outstanding debtor at the year end, definitely you have a chance of credit risk. You have a chance of bad debt. Okay, now use your brain. They will give you a separate story, but still you have your brain. Notice was received on 10th January X9. No matter. Notice was received on 10th January X9 that a customer owing 1 or 2 million, 1.2 million at 31st December X8. See, this is very important line. That means receivable at the year end. Debtor was there at year end. And when you have a debtor, when you have an outstanding debtor at the year end, that means you have a credit risk at the year end. And when there is a credit risk, there is a chance of bad debt. Yes. So it's an adjusting event. Had ceased trading, it is unlikely that the debt will be recovered. Again, this is adjusting event. Why this is adjusting event? Because We have evidence at the year end. We have evidence, we have credit risk at the year end that the customer will run away. Whenever there is a debtor, there is a credit risk. Whenever we have a debtor, we have a credit risk. So yes, this is also adjusting event. And I repeat, if you see my notes or if you read the book, these two examples are directly written in the books in the section of adjusting event. Now the third one, acquisition. This is takeover, acquisition of a competitor. Without reading this, I can tell you, takeovers and mergers after the year end, they are normally finalized. They are normally finalized on the last date. They are normally signed and finalized on the last date. So in this case, this is non-adjusting event. This is normally non-adjusting event. Now, please, students, the acquisition of competitor was finalized on 10th of January X9, being the date Jeffers company obtained control over the competitor. Negotiations in respect of the acquisition commenced in May X8. No issue. We have started negotiation, but it was finalized. It was materialized on January X9. So now wait, this is non-adjusting event. These takeovers, mergers, or issue of shares just after the year end, these all are non-adjusting event. These all are non-adjusting events. Okay, so we have, out of these three, the first two are adjusting and the third one is non-adjusting event. Okay, now without wasting a single second, without wasting my dear students, my beautiful students, without wasting a single second, let's move to our questions. Then we'll read this last paragraph. The first one, come on. You can see on the screen, giving you 30 seconds of 1 minute. You have 1 minute. Come on, tell me what's the answer of question number 1? What's the answer of question number 1? Very good. Majority students are giving correct answers. Very good. So nice of you. Events after the reporting date are deemed to be all events from the date financial statements are authorized for issue until the date of annual. No. It's, the scope of IAS 10. It's from the reporting date to the date financial statements are authorized for issue approved. So there is no such thing written as annual meeting or that board meet, that AGM. Annual meeting means AGM, annual general meeting, nothing like that. So first one is total false. Totally false. Number 2, non-adjusting event do not need to reflect it in any part. No, we have to write in the disclosure section. So we have to write in notes to the accounts. We have to write in notes to the accounts. So my dear student, 1 and 2 both are false. D is the answer. D is the answer, right? So next one, which of the 3 events I just taught you, which occurred in Jan, would be classified as adjusting? The 1 and 2 are adjusting. So answer is A. We have already discussed. Right? Now, the third one, let's read this paragraph, please. In addition to this, there is an outstanding court case at 31st December X8. I'm reading this paragraph. Students, please be alert. In addition to this, there is an outstanding court case at 31st December X8 relating to faulty goods supplied by Jeffers Company. Legal advice states that there is a small chance that they will have to pay out 6 million, small chance. But the most, yes, this is the word, most likely outcome is 5 million. I hope you remember, I always teach like this, in the chapter of IAS 37, there are 3 conditions for provision: present obligation, probable outflow, and reliable estimate. In the third section of reliable estimate, we teach 2 techniques. Of statistics techniques. The first one is EVA. expected value analysis, EVA. And my dear respected student, the second technique is most likely outcome, right? So EVA we use when there is a large number of transactions like warranty claims and all. But for most likely outcome, normally we use most likely outcome in case of single transaction. In case of single transaction like court case. So this question is about court case. So it's a single transaction. So we will use most likely outcome. Okay. So most likely outcome is how much? 5 million. So keep this thing in mind. This is a relevant number. Either way, Jaffer company will have to pay legal fees of 0.2 million. Yes. This is what unavoidable legal cost. You win or lose. Remember my dialogues. You win or lose, you have to pay lawyer's fees. You win or lose, you have to pay lawyer fees. So this is a mandatory. This is a must thing. 0.2 million you have to account for. Now, read this word. All payments means this 0.2 and this 5. This 0.2 all means both payments are expected to be made on 31st December X9. So my beautiful students, listen. Right now we are at 31st December X8. Right now we are at 31st December X8 and we have to pay the cash flow after 1 year. So hope you remember these famous dialogues. All obligations which are payable 1 year or after, all obligations which are payable 1 year or after need to be discounted, need to be discounted. Okay. So we have 10% interest rate and this is discount factor. So very simple. We'll do 5.2 million multiplied by 0.909. 5.2 multiplied by 0.909 will give you 4.72 something. 4.72 something. So this is the thing which we have to book as a provision. 4.72 or 4.7 which we need to book as a provision. Okay, right? Now for students, look at here. C. This is the answer. Question number 3, answer is C. Question number 3, answer is C. Okay, now question number 4. Now read the last line. Use your brain. Hope you remember contingent asset. There is one last topic of IS 37 which is contingent asset or possible asset. Remember? So now just think, we provided 40 goods to customer. So customer came to us. We provided 40 goods to customer. Customer filed a suit against us. So we turned back and we filed suit against our supplier because our supplier provided us the bad things, right? So now whatever we'll claim from our supplier, that will be a contingent asset for us. Whatever we'll claim from our supplier, that will be a contingent asset for us. Okay, now read it. Jaffer companies, this line please students. Jaffer company believes that fault lies within the supplier. That means our supplier provided us bad things and is pursuing a counter claim. Legal advice states that it is possible, only possible, but not likely. Likely means probable. Likely means probable. Remember that the action will succeed. Now, just use your brain. It's a contingent asset. It's a contingent asset, and the chances to receive this, contingent asset is only possible. Chances to receive this contingent asset is only possible. So whenever there is a contingent asset and chances are possible, you don't do anything, even no disclosure. Yes, we do disclosure if it is probable. We do disclosure in case of contingent asset if it is probable. And yes, if contingent asset is virtually certain, then we book it, we make the entry, right? So now let's move. Number 4. See the question, please. Number 4. At 31st December X8, which of the following represent the correct accounting treatment of the counterclaim made by Jeffers? Answer is A. Nothing is recognized or disclosed, right? Do nothing. It's do nothing. It's do nothing. Question number 4. Somebody is asking a question. Legal cost is virtual. It's don't call it virtually certain. Just we have to pay. So still this provision and liability is the same thing, and examiner is asking the total amount of payable. Examiner is asking about total amount of payable. That's why we combined it. Now this is a general question. Hope you remember it. In IAS 10, we generally teach this thing. In IAS 10, we generally teach this thing that normally for adjusting event, there must be an evidence. Normally for adjusting events, there must be an evidence at the year end. For non-adjusting event, we don't need any evidence. But there is an event which is called going concern. If after the year end, company came to know that company is no longer a going concern, so in that case, whether you have evidence or not at the year end, still this is adjusting event, and you have to prepare complete financial statement on breakup basis. Okay, so in short, going concern is always an adjusting event. And you have to prepare financial statement on breakup basis, because this is a very big event, because now company is going to be closed. Okay, so read question number 5 and pick the right answer. Question number 5 and pick the right answer, please. Now next, it's B. Yes, in February X9, a major fire broke out Jeffers company's property and warehouse. All property burned. Jeffers company has no insurance, and now the management of the company believes it is unable to continue trading. So it means everything is going to be stopped. And okay, this fire occurred suddenly. There is no evidence of this fire at the year end, but still, as this is so much pervasive that it will clean your company, it will stop all your operations. So yes, it's an event of going concern. So now the financial statement can no longer be prepared on going. Yes, you have to prepare financial statement on breakup basis. All other options are wrong. C, no adjustment should be made. This is totally wrong. C, no disclosure is required. This, yes, we need to write the disclosure as well. D is totally irrelevant. The financial statement should continue to be prepared. No. They have openly said that company is unable to continue trading. That means everything is going to be finished. Everything, your main trading operations are going to be stopped. So yes, company is no longer a going concern. Answer is B. Now next question, please. So we have a question, Lenity Company. Okay, please. Before this question starts, let me tell you one short example, easy example. Students, look at here. For example, I have to construct a building. And I only need, let us say, 50 kg cement. Just for example, I only need 50 kg cement or 50 packets of cement. But by mistake, I ordered 60. By mistake, I ordered 60. But in the end, I used only 50. So 10 are left. 10 cement packets are left. So obviously, I can return it. I can return it, or I can use it on any other project. So now on this project, I have only used 50 packets. So only 50 packets cost will be capitalized on this pack in this project. Okay. Whatever raw materials, cement, or these type of things you are going to use for that project, that will only count for capitalization. All the excess things, we can return it or we can use it on any other side. So that will not be capitalized on this project. Okay. This is a very common sense thing. Very, very common thing. So let's start. During the year ended 31st December X8, Lenity Company built an extension. Lenity Company built an extension to its head office. The cost associated with the construction of the head office extension are as follows. Now we are constructing. This is what we call self-constructed asset. So for self-constructed asset, IS 16 says you can capitalize all directly attributable cost. Only you cannot capitalize abnormal. Abnormal cost cannot be capitalized. Okay. All normal directly attributable costs are capitalized. So yes, the land acquisition, yes, this will be capitalized. Fees for environmental certification and building permits. Yes. Without this permit, you cannot start construction. Without this permit, you cannot start construction. Architect and engineer fees, yes, we call it professional fees. Without architect, you can't do construction. Now, construction material and labor, see the bracket, including unused materials. So this 6.6 million, including some unused, which I just told you. I told you a story. So we need to remove the unused material from this. Read it. At 30th September X8, the date when the head office extension became available for use, the cost of unused material on site to 0.5 million. So what does it mean? Out of this 6.6, 0.5 is unused. 0.5 is unused. So only 6.1. Only, my dear students, respected students, only 6.1 million. Only 6.1 million is used in this project. So only 6.1 million will be capitalized. Now wait. Hope you remember a very one class standard IS 23. Hope you remember this IS 23 borrowing cost. Borrowing cost. Hope you remember borrowing cost. Remember that if you are doing construction of a qualifying asset, if you have taken loan to construct a qualifying asset, and you have taken loan for that qualifying asset, then yes, you can capitalize the interest. You can capitalize means you can record interest as an asset, and this interest cost will be the part of that asset cost. Okay, hope you remember IS 23. We have studied in the class as well. Now read it. At that date, the total borrowing cost incurred on a loan which was used to specifically, see the word specifically, finance the head office extension amounted to 0.8 million. Yes, this will also be capitalized. Because this is specific fundings. This is specific borrowings, specific, not general borrowings. Okay. Now listen. So we have 10 plus 0.5 plus 1. Then we have this 6.1. So, and then finally we have this 0.8. Now, can anybody tell me what's the total? 10 plus 0.5 plus 1 plus 6.1 plus 0.8. I think it's 18.4. Somebody told me. Am I right? The total is 18.4. The total is 18.4. Okay. Just take 30 seconds. Take 30 seconds, students. Okay, So the question number 1, see the question number 1, please. For the year ended 31st December X8, how much should be capitalized in respect of the construction of the extension of the head office building? The answer is A. Okay. Now question number 2. It's a general question, giving you 30 seconds. Come on, take your decision, take your decision. Be confident and take your decision, please. Now, yes, majority have given the correct answer. Lenity company incurred further expenditure of the head office extension after it had been completed. Okay. Yes, further cost can be capitalized. This is called further measurement, subsequent measurement. Hope you remember. So, which of the following would qualify as a property insurance premium? No. Insurance is, listen, insurance is a routine expenditure. We pay insurance premium every year. So whatever thing is recurring, whatever is a recurring thing is a revenue expenditure. Okay, like rent, electricity bill, telephone bill, cleaning, these all are recurring. Okay. One more thing, without insurance, without paying insurance, we can bring our premises in useful condition. Now leave the B. C, marketing cost. Marketing cost is always an expense. Marketing cost, advertising is always an expense. Maintenance is always an expense. Now what is left? Installation. Yes, installation cost can be capitalized. Basic IS 16, installation cost can be capitalized. Installation cost can be capitalized. Now, question number 3. Question number 3, giving you again 1 minute. Again, it's a generalized question. Question number 3, you have to pick the false one. My dear student, you have to pick the false one, please. Pick up the false. Okay, let me talk. Let me discuss. You have to pick the false one, and yes, we are on revaluation model. In subsequent years, the depreciation will be based on revalued amount of the head office. Yes, this is true. This is true. Once you revalue it, once you revalue your premises, then yes, you depreciate. Further depreciation will be done on the basis of revalued amount. Further depreciation will be done on the basis of revalued amount, Okay, this is true, but we have to pick the false. Any gains on the head office building is recognized in OCI, yes, and any loss in PNL, yes. Listen, first time upward revaluation goes in OCI and first time downward revaluation goes in PNL. So apparently this is correct. This is also true. Now leave the C part, first do D. The residual value and the useful life of the head office must be reviewed each year. Yes, this is true. This is the instruction of IS 16. Hope you remember. The residual value and useful life is judgment, is estimated, and estimation depends on availability of information. So every year you get new information. So this is the instruction of IS 16 to revise your useful life and residual value every year, to check whether your life and residual value is revised or not. So yes, this is true. Now read C. Each component part of the head office being no, this is false. No, I told you, If you apply revaluation model on one class of asset, on one asset, complete class of asset will have the same model. If you apply revaluation model, look at here. If you applied revaluation model on one asset, you need to apply that revaluation model on complete class of asset. And hope you remember I gave you this lecture that all properties are one class of asset, all vans are one class of asset, cars are one class of asset. So just think, when all properties are one class of asset, so if you revalue one property, you have to revalue all properties. So yes, the complete property is revalued in one go. Complete property is revalued in one go, not through components. Okay, so this statement is false. C is false statement. C is false statement, please. Now, my dear student, question number 4. This is CGU. Hope you remember the CGU thing. Hope you remember the CGU thing. Let me do something for you. So this is carrying value. This is impairment. Okay. And this is the final thing. So your total, see, carrying value of CGU. Lenity company also acquired 100% subsidiary. Subsidiary is an ideal example of CGU. On 1st of January X8, the carrying amount of the assets of Scully in the consolidated financial statement of Lenity Group at 31st December X8 immediately before an impairment review were as follows. Listen. So you have total carrying value of CGU is 11.8. Carrying value of CGU is 11.8. And what is the recoverable amount? The recoverable amount of the CGU is 9.6. So first of all, calculate the total impairment. Total impairment is how much? Total impairment is how much? Tell me. 11.8 minus 9.6 is 2.2. Yes, they have ready-made given you. Total impairment is 2.2. Total impairment, my respected students, is 2.2. Okay. Now, how to spread? This is the total impairment of the total CGU. How to spread this impairment? Number one is obvious impairment. There is no indication of any obvious asset. There is no hint of any obvious impairment. So leave it. Now, second step is complete goodwill. Complete goodwill will be written off. So out of this 2.2, you're going to subtract 1.4. So you will have a remaining impairment of 0.8. You will have a remaining impairment of 0.8. Okay. Now this remaining impairment will be distributed between remaining assets that falls under the scope of IS 36. So never ever give anything to current assets. Current assets are already at their recoverable amount. Nothing you will give to current assets or cash. Nothing you will give to current assets or cash. So obviously now these two players will bear the remaining impairment, brand name and property, plant and equipment. So how are you going to do it? Through their respective carrying values. So 2 plus 6 is 8. 2 plus 6 is 8. So what will be the fraction for brand? 2 divided by 8. Just check. 2 is the carrying value of brand. And what is the total carrying value of these two? It's 8. Multiply by, you will do 0.8. How much is this? 2 divided by 8 into 0.8. It will be 0.2 here. And yes, 0.6 will come here. So how much the value of brand? How much is the value of brand after this impairment? 2 minus 0.2, 1.8, and this is 5.4. So I have solved the complete question. In front of you, but the examiner is not asking you to solve complete. Students, please. They are just asking you the value of brand. They are just asking you to the value of brand, Yes, it's 1.8. So let me move the screen. Assuming Scully company represents a cash generating unit, when what is the carrying amount of the brand at 31st December X8? It's 1.8. So answer is D. It's 1.8 million. So your answer is D. Okay. Point number 5. Question number 5, please do it. Question number 5, it's easy, not difficult. It's very easy. Which of the following statements is correct? Is our at the end of each reporting period, an entity should assess if there is any indication that assets have been paid. True, true, true. Yes. Remember, I told you we never book impairment directly. We never book impairment directly. First we see, is there any indication? First we check, is there any indication? If yes, there is an indication, we do impairment test. If no indication, no impairment test. So this is a mandatory thing. This is a mandatory thing that we need to check whether there is impairment hint or not. Whether is there any impairment indication or not. If yes, there is a hint or indication, we have to do impairment review or impairment testing. So this statement is totally correct. This statement is fair. Now, number 2, annual impairment reviews are required on intent. Yes. You remember 3 assets for which if there is no hint, is given, still we need to do impairment testing at least annually. One is intangible asset with indefinite useful life. Second is goodwill, purchase goodwill, remember, and third is intangible asset not yet available for use. So this point number 2 is out of that 3 things, right? So both statements are correct, both 1 and 2. C answer. C is the answer. Now let's move to one OT case of IFRS 9. IFRS 9. See, this one, Diaz company. This is related to IFRS 9. Can you see? It's connected to IFRS 9 and IAS 2. IFRS 9 and IAS 2. Okay. Now, you have at the year end the valuation of your inventory. The valuation of your inventory is 8.6 million. Okay. Right now the valuation of inventory is 8.6. Your receivables are 6.2. And you have a 5% loan notes. Obviously, it's a liability. Loan notes on the credit side, so it's a liability, okay? And this 5% is always a coupon rate. The rate which is adjacent to the loan note is always the coupon, rate, okay? Now, the first thing, this basic thing is related to F3 level. This is the F3 level thing. Even we teach this in F3, but still sometimes it's dodgy for students. So let's do, because the basic things are also coming. The inventory count was completed on 31st December X8, but 2 issues. We need to resolve 2 issues. Don't sleep, please. Have been noted. First The first issue, product with a sales value. Product with a sales value means selling price, of 0.6 million had been incorrectly excluded from the count. So now what we have to do, we have to include it. We have to include it because they have excluded it. Now wait. This 0.6 million is the selling price. Let me write SCP. Hope you remember this thing, SCP, percentage and dollars. So this 0.6 is the selling price. This 0.6 is the selling price. Now tell me, we are charging markup or margin? We are charging markup or margin? We are charging markup on margin. It's markup, right? So in markup, cost is always 100. Profit is 50. So it's 150. Okay. Selling price is 150. Selling price is 150. Can you see the screen? Can you see the complete screen? So now this 0.6. Now this 0.6 is equivalent to 150. 0.6 is equivalent to 150. So how we'll calculate the cost? 0.6 divided by 150 into 100. 0.6 divided by 150 into 100. 0.6 divided by 150 into 100. This will give you 0.4. This will give you a cost of 0.4. Now wait. The cost is 0.4. Now use your brain. We all are sure for one thing. We all are perfectly 100% sure for one thing, that this transaction has been excluded. This transaction has been excluded from the inventory count. This transaction has been excluded from the inventory count. So now we need to include something. But you know, in IS2, we always include inventory. We always value inventory at lower of cost or selling price. So now out of this 0.4 and 0.6, out of this 0.4 and 0.6, out of this 0.4 and 0.6, which one is lower? 0.4 is lower. 0.4 is lower. 0.4 is lower, right? So we'll add 0.4. Wait, this 8.6 was the original amount. We'll add 0.4. See, the first transaction is done. First issue has been resolved because they have excluded it. So now we need to include. They have excluded it. So now we need to include. Now we need to include. Okay. Some students are asking that they don't know markup and margin. See, this is very basic thing. If somebody has issues, like I have one lecture in Hindi, Urdu language of markup and margin, take it from me. But markup and margin, you must know from your basics. Markup is profit percentage on cost and margin is profit percentage on sales. But again, I would say, if somebody doesn't know, then he or she should learn it. She should take the class properly, okay? Because of this markup and margin, you will get complete 0 in your MCQ and OT case. Be careful. Each and every mark is important. Now the second issue. Second items costing 0.2 million, which had been included. See, this 0.2 is already included. 0.2 is already included, but there is a problem. In the count word damage means something is bad. Now this is the indication that NRV has gone down and could only be sold for 50% of the normal selling price. 50% of not cost, 50% of normal selling price. So first of all, we need to calculate selling price. Wait, let me write SCP dollar and percentage. Wait, now you have 0.2 million as a cost. This 0.2 is your cost. And you know, we have a markup. In this question. So in markup, cost is always 100. Profit is 50. So this will be 150. So can anybody tell me the selling price? 0.2 divided by 100 multiplied by 150 will give you 0.3. So 0.3 is your normal selling price. 0.3 is your normal selling price. 0.3 is normal selling price. Look at here what they are saying. And let me read again. See, They are saying could only be sold for 50% of the normal selling price. Now wait, what is the cost? What is the cost? Cost is 0.2. And now what is the NRV? They are saying NRV means net realizable value. Now what is the realistic selling price? 50% of the normal selling price. 50% of the normal selling price. Can anybody tell me what is the normal selling price? Normal selling price is 0.3. 0.3 is the normal selling price. Now may apply 50% on it. So half of 0.3 is 0.15. Now you tell me, inventory, they have already included at cost. They have already included this inventory on cost. Okay. But IS2 says inventory should be recorded at lower of cost or NRV. IAS2 says inventory should be recorded at lower of cost or NRV. So which number is lower? Which number is lower? My good students, which number is lower? NRV is lower. So we need to bring this 0.2 to 0.15. We need to bring this 0.2 to 0.15. So we have to subtract 0.05 from this. So we'll get the correct inventory number. So how much is this? 8.6 plus 0.4 minus 0.05. 8.6 plus 0.4 minus 0.05. How much is this? 8.95 is your correct answer. Now, for this second transaction, I can explain in one more way when I teach F3 level, because I teach all levels. I teach F3, F7, SBR, all level. I teach baby kids, infants, you know, infants, baby. I teach babies as well. So when I teach infants, I do it in more spoon feeding way, like 8.6 plus 0.4, 8.6 plus 0.4. First you subtract complete 0.2. First you remove complete 0.2, and then you add 0.15 in the room. First you delete 0.2 from the room, complete 0.2 from the room, and then you add 0.15 in the room, because the item is still the closing stock. The item is still the closing stock, which is unsold stock. So you can do it in this way as well. First subtract 0.2 and then add 0.15 in that room. So automatically you will get the same effect. But again, I would say, now you guys are no more kids. You have done complete course of F7 now, complete course. Even you have done the revision days. So now your knowledge must be more than an F3 students. Okay. Just give me 30 seconds. Hello. कराओ जल्दी करो. Take your time. I'm just giving you 1 minute to think over it. I'm not doing anything. You just read this part. Both issues. One is excluded, one is included. One is excluded, one is included. Hello. Did you understand? Please hit on the chat box. If you understood the part, hit the chat box, please. Write on the chat box, please, all of you. Write in the chat box, please, all of you. You know, this type of questions normally comes in A levels as well. A levels exams as well. Okay, now let me check the MCQ for this. First of all, Question number 2. What is the correct carrying amount of inventory valuation to be recognized in? This is answer is 8.95. A is the answer. A is the answer. A is the answer, right? Now the next one is, this is generalized question. Let's see your mind. In a quest point number 1, in accordance with IS 32 financial instrument presentation, which of the items in the trial balance would be classified as a financial instrument? So financial instrument, hope you remember financial instrument. It's a contract which gives rise to financial asset for one entity and financial liability or equity instrument for other entity. Now wait. In point number 8, closing, never, no. Inventory is not a financial asset. Remember, inventory is not a financial asset because inventory is not a cash, or it's not a right to receive cash. So no. 5% loan notes only? No. We have one receivable as well. Wait a minute. Okay, so only loan notes are not financial instrument. Receivable, yes, receivable and loan notes both are financial instrument. Why? Receivable is a financial asset, yes, and because of receivable there is a financial liability in the other books. And loan notes, yes, loan notes give rise to financial asset at one entity and financial liability at another entity. So in this trial balance, see the trial balance. In this trial balance, this trade receivable and this loan notes both are financial instrument. Both, very basic question. Both are financial instrument. So answer is C. Question number 1, answer is C. Now, again, a very generalized question. Read, please check it out. Please check it out. This is very general question. Hope you can do it. Yes, cash is also financial instrument, cash, but there was no cash written in the trial balance. Question number 3, please. In an attempt to improve reported profit, the directors of the AS company wants to change the valuation method from to FIFO to average cost. Yes, this is change in accounting policy. Change in accounting policy, and yes, change in accounting policy is always adjusted retrospectively. So the change will no. This is change in accounting policy. The financial no change in accounting policies are adjusted retrospectively. So answer is D. Answer is D. Answer is D. Now, hope you remember a topic which we called factoring. Remember, this is our company, this is our customer, and these are factors. Hope you remember, when we do credit sales, to our customers, whenever we do credit sales to our customers, there is a debtor in our books, and now factor normally pays us 90% or 95% amount. Factor normally pays us 90% or 95% amount. So obviously you need to make the entry bank debit. Whenever you receive funds from factors, whenever you receive funds from factor, you have to debit bank. Now there are two major issues. There are two types of this factoring. First is insured bad debts and the second is uninsured bad debts. One is insured bad debts and the second is uninsured bad debts. Okay. If the bad debts are insured, that means factor said, yes, bad debts on my side. So that means now you have transferred. Now you have transferred the risk and reward. Now you have transferred the risk and reward of your receivable. That means in reality, you have sold your receivables. In reality, you have sold your receivables. In reality, you have sold your receivables, right? Okay. So in that case, what you do, you debit bank, you credit your receivable, And if there is a difference, slight difference, you book it in P&L. If there is a slight difference, you book in the P&L. Okay, so this is the treatment of insured. This is the treatment of insured. Okay, but what happens when there is uninsured? When the bad debts are uninsured, that means we still bear the risk and reward of receivables. We still bear the risk and reward of receivable. So in that case, you debit bank and you credit loan from factor. Okay, if you have done the question Highwood of final account, in Highwood question, I think this is the last adjustment. So this is going to be uninsured. This is for uninsured, dear student, and the second one is insured. Second one is insured, right? Now let's read the facts and figures of this question. Let's read the facts and figures of this question. Listen, the Diaz company entered into a factoring agreement with Fine Company on 31st December X8. In accordance with the arrangement, Diaz company sold, just this is a word sold, but we need to check the facts as well. We need to see the facts and figures as well. Sold trade receivable with a carrying amount of 6.2 million to Fiat Finite Company for 6 million. Okay, so that means we received this cash. We received this 6 million. We received physical cash of 6 million from the factor. Now the major thing is it's insured or uninsured. Read it. Under the terms of the factoring agreement, after 6 months, Finite Company will return any unpaid receivable to Diaz company for collection. See, that means this is uninsured bad debts. This is uninsured bad debts. That means they will wait only 6 months. The factor will wait only 6 months. After 6 months, they will throw you back. They will throw you back the receivables, and now we will be responsible. So this means this deal is pure uninsured. So for uninsured deals, we have to make entry bank debit and loan credit. For uninsured factoring deals, we have to make entry bank debit and loan credit. And yes, whenever you book a loan in your books, so that means you need to book finance cost with the period of time. You need to book finance cost or interest expense with the period of time. Okay, see, this is written. Finite Company will also charge Diaz company 5% of any uncollected balances at the end of each month. At the end of each month, right? At the end of each month. Right? So now this is uninsured. Let's read. Which of the following statement regarding the factoring arrangement is not true? See this. What they are saying, it's not true. Can you see? That means you have to skip the true ones. It is also written in the examiner report. Students don't see this. See NOT. They have written NOT capital. Sometimes we do these mistakes, these stupid mistakes, to be very honest, that you have to pick the not true. You know everything, but you don't read the requirement. So 6 million received should be recorded. This is true. Yes, as this is uninsured deal, so it's true. Now wait, first read this. A total of 5% monthly fee should be expense. Yes, 5% monthly fee. Yes, this is also true. This is finance cost. This is finance cost. The receivable will remain as an asset. This is also true. Yes, because this is uninsured deal. This is uninsured deal. So receivable will still be part of our books because we bear the risk of receivables. We bear the risk of receivables. So we are not going to de-recognize the receivable. We are not going to de-recognize the receivable. So A, C, and D are true. Now read the B point. 0.2 million should be expense. No, this is false. Point C, wait. If this was insured, wait. If this was insured deal, what should be the entry? Bank debit 6, receivable credit 6.2, and yes, we'll book 0.2 in PNL. We'll book 0.2 in PNL. This would be the entry if this deal was insured. If this deal was related to insured bad debts. If this deal was related to insured bad debts. If this deal was related to insured bad debts. So answer is B. Did you understand, my dear students? Now number 5. Number 5 is the thing which we practice a lot in the class. See, it's 5% loan notes. Look at this 5% loan note thing. Look at this 5% loan note thing. The value is 9 million. Okay. Now, hope you remember this facts. The 5% loan note were issued for 9 million. See, this is the actual amount of cash we received. Hope you remember the amortized cost accounting. Use your brain. Amortized cost accounting. We start amortized cost with the net cash we receive. We start amortized cost table with the net cash we receive. So keep in mind, first of all, we received 9 million and see the date. It's 1st July X8, like on the mid of the year. Our year end is 31st December X8. Our year-end accounting period ends on 31st December X8. So we took loan in the mid of the year. Now this information is very relevant because now we have to apportion the finance cost. We need to apportion the finance cost. Hope you remember. Dia's company incurred issue cost of 0.5 million associated with this, which have been expensed within finance cost. It should be, listen, this issue cost must be, yes, this issue cost become part of finance cost, but with respect to time. This issue cost becomes part of finance cost, but with respect to time. So what we do initially, subtract this 0.5 million from 9. We subtract 0.5 from 9, okay? The loan note interest is payable at 30th June, means after every 1 year. We took loan on 1st July. We took loan on 1st July X8. So after 1 year, 30th June X8, X9, we'll be paying the first one. And the loan is to be repaid at a premium, okay? Giving them effective, very important line, effective interest rate. Yes, we book interest expense. We book interest expense using effective interest rate. We book interest expense using effective interest rate. Giving you 30 seconds or 1 minute. Can you calculate the finance cost for this year? Can you calculate? Very good. Some students have done correct. Can you calculate the finance cost for this year? Okay, let me teach you. Listen, we received the face value. We received 9 million and no discounts. Okay, we received 9 million cash. Now On the same day, we gave 0.5 to the lawyer, less issue cost, wait, it's 0.5. So how much net cash we receive initially? We receive 8.5. Hope you remember these columns. This is amortized cost brought forward. So you have 8.5 and this is interest expense. Now wait, they are in respect of the 5, how much should be expense within Diya's company's profit and loss for the year ended 31st December X8. So yes, you need to book only 6 months. So how you need to calculate 8.5 multiply by 8% times 6 upon 12. How much is this? 8.5. Okay, 0.34 million. Yes, this is your expense. This D is your answer. D is your answer, 0.34. Only they are asking about the interest expense. Okay, dear students. Now I would like to, in the end, I would like to say that be very careful with IFRS 15. My lectures are updated because IFRS 15 has changed. The construction accounting of IFRS 15 has changed, but I have seen some WhatsApp messages. Some students are using old kits. Don't use it. Use the new kit, which is relevant from September 2022 onwards, right? For IFRS 15, you need to use new kit, and it's advisable because in the consolidation area, there is P2A and A2P sales. P2A and A2P sales, there is a little change as well. So please, students, look at here. You must use new exam kit for F7 and new study text, especially for IFRS 15, because otherwise you will be confused. Otherwise, my dear students, you will be confused. Be careful for that. Okay. One more thing I would say that I have yesterday I made a video. But that's in Hindi Urdu language. That now ACCA UK has given you a special facility. Those who have appeared in last attempt September 2022 skills module for any non-variant paper like F5, F8, F7, F9, these are non-variant paper. Leave it F6. For these paper, now they will give you a personalized feedback. ACCA has given you personalized feedback. It's not generic feedback. One thing is generic feedback like exam report. One thing is generic feedback like exam report or read the mind of the marker. Yes, exam report you should read. It's also advisable. But now what I'm saying, it's very important, personalized feedback. Feedback for your own paper, whether you have passed or failed. Go to my ACCA examination link and you will see your performance dashboard. Okay, performance dashboard, and in that you will get a detailed feedback about your time management, that how did you manage your time, how did you perform good in which syllabus area, how did you perform in first 60 marks, how did you perform in last 40 marks. So this is very, very advisable. You will come to know your mistakes, and this is a great thing ACCA did for you guys. Okay, like the best use of data. So don't forget to read that thing before the exam. Also read the exam report as well. And just for your motivation, I'm saying that you have done everything. Those who studied a full-time course, revision days. So just for your motivation, I say that although the global pass rate of F7 paper is 50% plus, which is already good, but normally when ACCA sends us the pass paper, my pass rate is 80% plus. So 80% plus is a very good pass rate. This is a motivation for you guys, that you guys are in safe hands. So just think about pass, and pass. Don't think about fail. If you think about fail, you will continue with negative thoughts. Okay, so go do what is advice. Be confident, read the summaries, read the exam report, read your own feedback of last attempt. If somebody has failed, then he must review his or her own feedback. Okay, right? So I'll send you the slides as well of this. Best of luck for your exams and take care. Allah Hafiz.